there's something Wall Street doesn't want you Googling before the World Cup. Every 4 years, billions of people stop working, stop sleeping, and stop thinking about anything except a ball and a net. And while you're watching Mbappe or whoever the next guy is, the stock market in your country is quietly doing something that makes no rational sense whatsoever. And here's what's wild: economists have known about it for decades. There's a published study in one of the most respected financial journals in the world that proves it. And almost nobody in the personal finance space is talking about it. So today we're going to look at what the historical data actually shows when the World Cup and the stock market collide. Not opinions, not predictions. Data. By the end of this video, you're going to understand a psychological force that moves billions of dollars in financial markets, and you'll know exactly how to think about it as an investor. We're covering 5 things: the study that changed how economists think about sports, the loss effect and why it's bigger than the win effect, what happens to host country markets, how Goldman Sachs tried to profit from this, and what this actually means for your money. Let's go. Segment 1. The study that shook behavioral finance. In 2007, 3 economists, Alex Edmans, Diego Garcia, and Garcia Norli, published a paper in the Journal of Finance called Sports Sentiment and Stock Returns. Now, the Journal of Finance is not a sports blog. This is one of the most rigorous peer-reviewed publications in academic economics. Getting something published there means your methodology got destroyed and rebuilt by the smartest critics in the field. So when this paper made it through, people paid attention. Here's what they did. They looked at 39 countries. They tracked 1,162 international soccer matches played between 1973 and 2004. And they asked one question: does a country's stock market behave differently the day after a major soccer loss compared to a normal day? The answer was yes. Dramatically yes. On the day after a country loses a World Cup elimination match, not a group stage loss, an elimination, that country's stock market dropped by an average of 0.49% compared to what would normally be expected. Now, 0.49% sounds small. But think about this in context. That's not an average return. That's a deviation from expected return. In other words, the market didn't just not go up, it went down by nearly 0.5% relative to where it should have been, with no economic news, no earnings report, no Fed decision, just a soccer loss. For a market like the United States, which at any given time represents roughly $40 to $50 trillion in equity value, a 0.49% move is not small. That's hundreds of billions of dollars of value shifting because people are sad about a game. And they confirmed this wasn't noise. They controlled for day-of-week effects, seasonal effects, market volatility, all of it. The soccer loss effect was statistically significant and robust. Wait, before you think this is just about soccer, they checked other sports too. They found similar but smaller effects for cricket, rugby, and ice hockey in their respective dominant markets. But soccer was by far the strongest signal, because soccer is the only sport on earth where the emotional stakes are truly global and truly uniform. Segment 2. Why losses hurt markets more than wins help them. Here's the part that gets really interesting from a psychology standpoint. And this is where the data gets uncomfortable. Wins don't produce the mirror image effect. When a country wins a World Cup match, their stock market the next day shows a small positive bump, but it's weak. Statistically much weaker than the loss effect. The economists called this asymmetric. This is not surprising if you've ever studied behavioral economics. There's a concept called loss aversion, documented by Daniel Kahneman and Amos Tversky, which found that psychologically, losing something feels roughly twice as painful as gaining the same thing feels good. Your brain is wired to feel a $100 loss more intensely than a $100 gain. What the World Cup data shows is that this psychological asymmetry isn't just personal. It scales to the level of entire national economies. A country loses a soccer match and millions of investors independently, without coordinating, become slightly more pessimistic, slightly more risk-averse, slightly more likely to sell or hold rather than buy. And that collective mood shift moves markets. Think about what that means. These are professional fund managers, institutional investors, people with Bloomberg terminals and quantitative models. people who are supposed to be immune to emotion. And they're still subtly affected by whether their national soccer team lost last night. The Edmans paper estimated that in high-stakes elimination rounds, the loss effect was even more pronounced. The bigger the game, the bigger the market drop. World Cup eliminations showed a stronger effect than qualifying matches. The final showed a stronger effect than the quarterfinals. So the more people care, the more the market moves. And people care most about the World Cup of anything on Earth. Segment 3. What happens to the host country's market? Now let's talk about the host nation, because this is where conventional wisdom completely falls apart. The popular narrative around hosting a World Cup goes like this. You build infrastructure, you attract tourism, your economy booms, your stock market surges. It's an economic party. Governments sell it to their citizens on exactly this basis. The data tells a different story. Brazil hosted the 2014 World Cup. In the months leading up to the tournament, the Bovespa, Brazil's main stock index, declined significantly. During the tournament itself, while games were being played in Brazilian stadiums, Brazilian stocks continued to struggle. The narrative of the World Cup boost was almost entirely absent from the actual market data. Brazil, politically unstable and dealing with inflation and protests, saw the spectacle of hosting without the economic reward. South Africa hosted in 2010. Similar story. The JSE All-Share Index was recovering from the 2008 global financial crisis during this period, and while there wasn't a dramatic tournament-related crash, analysts found no statistically significant boost attributable to hosting itself. The jobs created were largely temporary. The infrastructure spend was enormous. The long-term economic legacy was mixed at best. Russia in 2018 is actually the interesting outlier. The MOEX index did show positive movement in the lead-up to the tournament, and Russia's market outperformed in the pre-tournament window. But economists largely attributed this to oil prices and geopolitical factors, not the World Cup itself. Here's the pattern that researchers have actually documented. Host countries get a short-term consumption boost, hotels full, restaurants busy, merchandise sold. But the stock market, which prices in future earnings and investor sentiment, doesn't necessarily respond to that consumption boost because sophisticated investors also price in the long-term costs of hosting debt from stadium construction, security spending, infrastructure that becomes underutilized after the tournament ends. The academic term for this phenomenon, the gap between projected and actual economic returns from mega events, is sometimes called the winner's curse. You win the bid, and then you discover what winning actually costs. Segment 4. Goldman Sachs tried to trade this. Here's what happened. In multiple World Cup cycles, Goldman Sachs published reports trying to predict tournament outcomes and map them to market movements. They built econometric models, they hired analysts, they treated the World Cup like a tradable financial event. And their prediction record was, let's be honest, mixed at best. Their models correctly identified favorites but consistently underestimated upset probability in the knockout rounds. Because their models were built on historical performance data, squad depth, and economic factors, what they couldn't model was the psychological volatility of single elimination sports. One red card, one goalkeeper who has the game of his life, one penalty shootout that could go either way. These are events that don't care about your regression model. But here's what Goldman got right. Conceptually, even when they got results wrong, they understood that the World Cup was a sentiment event masquerading as a sports event. And sentiment moves money. The lesson isn't that you can predict World Cup outcomes and trade them for profit. The lesson is that some of the smartest, best-resourced investors in human history tried exactly that and couldn't do it reliably. Which tells you something important about how markets actually work. They're not just driven by economic fundamentals, they're driven by human emotion at scale. And human emotion, especially collective emotion tied to something as unpredictable as a soccer tournament, is genuinely unforecastable. So if Goldman Sachs with all their resources couldn't crack it, your fantasy portfolio? Rebalancing around match days probably isn't a winning strategy either. Segment 5. What this actually means for your money. Here's the real takeaway, and this is the part I want you to think about seriously. The World Cup stock market effect is what economists call a market anomaly. It's an irrational pattern. Markets should not move based on soccer results. Rational actors making decisions about the future earnings of companies should not care whether the national team won last night. But they do. The data proves they do. And the existence of this anomaly tells you something profound about every financial decision you've ever made. You are not a rational economic actor. Neither am I. Neither is your financial advisor. We are all emotional humans who tell ourselves we're making rational decisions while being constantly nudged by mood, context, and collective sentiment that has nothing to do with the actual investment in front of us. What should you actually do with this information? First, if you're an investor in countries with teams deep in the tournament, be aware that your judgment is being affected by something that has nothing to do with your investment thesis. That's not weakness, it's just biology. But knowing it lets you slow down. Second, don't make major portfolio decisions in the 48 hours after a crushing elimination loss for your country. The data suggests markets are briefly irrational in that window, and so are you. That's a bad combination. Third, zoom out. Every single one of the market dips documented in the Edmans study reversed. The stock market does not care about soccer in the long run. The Brazilian market recovered. The South African market recovered. Every country that lost a gut-wrenching World Cup game saw its stock market return to fundamentals within days to weeks. The World Cup stock market effect is real, but it is temporary. Long-term investors who held through those dips lost nothing. Emotional investors who reacted to collective national mood during a tournament potentially sold at temporary lows. Which investor do you want to be? The data is clear. The World Cup moves markets. Not because economics changed, because millions of people's emotions changed at the exact same time. And markets are just a reflection of collective human psychology expressed in numbers. Every time you see the market hiccup during the next few weeks of this tournament, you'll know exactly what's happening. You're watching behavioral economics play out in real time. Drop in the comments. Which country do you think has the biggest emotional investor base? Which elimination would move markets the most? I want to see your answers.